We are a intermediate-sized silver and gold producer with 3 mines in Mexico. And my job is to help the company with M&A strategy, so mergers and acquisitions. So help the company looking for assets, mostly anywhere in the world, but most of our focus is Latin America. So we have an office in Santiago, and I often come down to look at other projects. So Argentina is certainly on our radar nowadays with the recent election and improvements to the political environment. So this course here started off probably about 8 years ago, I want to say. I'm the organizer for one of the largest mining companies in Western Canada called the AME Roundup. And I'm on the short course committee. And one of the days we sat down and thinking, well, what courses do we need for the mining industry, for geologists? And I kind of thought, well, it'd be great to have a short course about the capital markets that teaches geologists, engineers about the finance industry, because we know mining is expensive, exploration is expensive, all the capital has to come from somewhere. But where does that come from? A lot of people who work in the industry don't really know how the money gets there. Myself, I'm a geologist. I worked in the field I graduated university in 1996, worked in the field for about 15 years before I started working for banks. And so it wasn't until I really started working for banks that I truly understood what the business side of mining was and the business side of geology. And I thought it's something that most of us have to learn just through experience. And so I thought, well, it'd be a great course to offer young geologists, or not even just young geologists, just even mining executives who have spent some time in the field, worked for mining companies, worked for exploration companies. They find themselves in a position that they're now running a company, and now they have to worry about, okay, now how do I finance, and how do I keep this company going? How do I grow the company? And so that's the root of this short course. And so I was asked to put it on. I said, yeah, sure, I can do that. It'd be great to have a panel of speakers, a group of speakers that have a similar background as myself, so background in geology, so not necessarily a background in finance or accounting or investment banking or business. Like we're all geologists. We've spent time in the field, so I called up some of my good friends and my mentors who are all in this room. You'll hear from later today, and we all have pretty much the same background. We've all spent time in the field, working in mines, at mines, exploration before we started getting into the business side of geology. So I will go first, provide an introduction to capital markets, and you'll hear later from Nikki. She'll give herself an introduction, and Joe, and then Neil. And then I'll come back again at the very, very end, and I'll talk about just project valuation. So this is kind of what the day will look like. Times are pretty flexible, but in general, this is how we'll go. 2 speakers, a break, and then we'll actually have 3 speakers at the end, not 2, after the break. Quick outline of what we'll be talking about. Introduction to capital markets, kind of what I just gave, what does it all mean, and then also talk about different ways of financing, how these companies, exploration companies with 0 revenue, how do they get money? Right? How do they get money to explore? How do they get money to drill? When they don't sell anything, they have 0 revenue. So capital markets. It's a part of a financial system concerned with raising capital by dealing in shares, bonds, and other long-term investments. So for the most part, we're going to be talking about shares. Because most companies like our company, my company, Endeavour Silver, we are a publicly traded company. You can go to the Toronto Stock Exchange, New York Stock Exchange. If you like our company, if you like silver, you like Mexico, or whatever reason, then you can buy shares of our company and you can invest. And you typically buy low, you want to sell high. So that's mostly what we'll be talking about here, just companies, public companies with shares on an exchange that you can buy and sell. So why are capital markets important? You can tell here, if you can see, I've highlighted 2 terms. This is a typical balance sheet for a publicly traded company on a financial statement. There's revenue and there's cost of sales. So this company is just a random company founded on the internet. And then you can see in the top line, it's metal sales. And you deduct the cost of sales and then you make your profit, and then you can finance your company that way. So this is a typical balance sheet for most companies who actually sell things, whether it's you're selling shoes, you're selling gold bars, you're selling cars, you're selling AI chips. You're going to have revenue and you'll have cost of expenses. This is a screenshot of a balance sheet of an exploration company. So you can see right away that there is no revenue. They don't even say revenue. So the highlighted term up there is statement of loss and comprehensive loss. So they don't even say we're going to bother making a profit. They just go right away and say, well, this is how much money we're going to lose. There's no revenue, and just the first item is just operating expenses. So this is your, I would say, 90% of mining companies. They have zero revenue. All they do is explore. No sales. So the money needs to come from somewhere. On the left, we have people, institutions with surplus money to invest. And on the far right side, those are the companies that need money. And in the middle, that money, how it goes from the people with money to the people who need money, that's what we call the capital markets. So it's all funneled through the capital markets. That's how it gets there. Now the surplus money, the people with the surplus money to invest, they could be either high net worth individuals, people with a lot of money, they've made a lot of money, and they're just looking for a place to deploy it. Or it could be institutions, investment management funds, pension plans. So any kind of institution with money. It could be even another company. It could be even a larger mining company like Endeavour Silver or First Quantum or BHP who's looking to invest in other companies. They also are a source of capital. But if in order for them to make an investment into those people who need money, they go through the capital markets. Here is an example of a conventional financing, and this is just a regular private placement. This would be the majority of financings, I would say. Don't have the exact number, but the majority of financing, probably 90%. 9 out of 10 financings would be like this. You don't have to read the whole thing. There's a lot of words, but the words that are highlighted in red are the ones you want to pay attention to. So it is best efforts private placement. Units, flow-through units, and some of these terms are specific to Canada. So in Canada, a flow-through unit, you won't find that anywhere else. There's warrant, so 1/2 common share purchase warrant. Here, half a warrant. This is a term, a length of time 24 months. There's commissions, brokers, and more terms, another term of 24 months. Now, what does this all mean? Best efforts means exactly that. So you've hired a broker to say, here, I have this company, I have this project, I need some money to drill it. Can you help me raise the money? You go to your stockbroker, you go to your bank, and then they'll say, sure, I can give you a try. It's best efforts, no guarantees. If you need $5 million, I'll go to my network, I'll make a few calls, I'll see what I can do. Might only get 2 or 3 million, but we'll see what we can get. Best efforts, that's a private placement. The units is what the brokers want to sell. So the unit has 1 share in the company of 53 cents. Okay, we can't really, sometimes it works, sometimes it doesn't. So here we go. So 1 share at 53 cents and a flow-through unit at 60 cents. So you almost get, for every time you buy a unit, you almost get 2 shares. You get 1 53 cents, and this flow-through unit is something that's unique to Canada, and what it is, it just provides a tax break for the purchaser. And so you have another unit, so that if the company does good and they're up over 60 cents, then that share also comes in the money. So it's an added incentive for you, the investor, to invest in that company. Otherwise, you could just go buy in the market. You wouldn't need this. You wouldn't need it, right? You can just buy in the market. But as an incentive to raise that $5 million, or for example, $5 million, they're going to give you a little extra bonus. So it's an incentive. There's also another unit here, which is called a 1/2 of a warrant. And a warrant is almost like a contract. It's an agreement that within 24 months, if you're the investor, you bought this private placement, you have 24 months at 80 cents. If it works here yet, at 80 cents. So if the share price does well, the company raises the money, does the drilling, gets some positive news, the share price goes up, and it gets over 80 cents, you have another option. You have an option to buy a share at 80 cents, and that becomes free trading, you can make more money. So that's a warrant, so it's like a free option. And it's good for 2 years. So anytime in the next 2 years, share price reaches at 80 cents, you can call up the company and says, give me more shares, give me those warrants. So that's what we call a warrant. And then the 6% commission, that's just the fees for the bankers. So you do a $5 million raise, they will keep 6% of that as fees. So you might only get, $4.7 million, so $300,000 in fees. The broker will also take warrants. They also get a little bonus. So not only do they collect a fee, but they will also get warrants. So if the company does well, that's more money for the broker. And then this is just kind of a summary of those terms. Best efforts, private placements, how many units, warrants, and commissions. Again, I won't touch on this too much, but the flow-through financings that we talked about earlier, it takes advantage of Canadian development investment tax credits. And what that means is that in Canada, you have your revenues, your typical company has revenues and expenses, and they're allowed to deduct expenses, and you only pay taxes on the profit after tax. You pay profits on taxes on profits after taxes, EBITDA. And so with exploration companies, remember, they have no revenue, so they can't use this tax deduction. They have no revenue, they have nothing to offset, they have no profit to offset. And so in Canada, what they do is have these flow-through units. So what it basically means, it's literally, it takes the tax credit from a company, exploration company, it flows through into the investor, the buyer. And what it helps for you is that you get that write-off on your taxes. So it's 100% deduction. So instead of paying taxes on, for example, 200,000 Canadian dollars their annual salary, if you take $50,000 in investment in a flow-through credit, you can reduce your taxes. So it's like you're only paying taxes on $150,000 salary rather than $200,000 salary. So you get a tax refund back right away. So that's what a flow-through is. I'm not sure if Australia has something similar. No, Nikki says no, or US, but this is strictly in Canada. And what it is because in Canada we are a resource export nation. We're founded on natural resources. So it's just an incentive that the government put into place to help promote investments in the mining industry in Canada. Tax shelter. This is another type of financing, which is what we call a bought deal. Very similar to a private placement, but instead of being at best efforts, where the broker says, okay, I'm going to give my best efforts, I'm going to try to sell your deal to my brokers, or my investors, my contacts. This is a type of a financing where the bank says, I like your company so much that I don't even have to market it. I'm going to buy those shares right away. And then I will worry about who finds them afterwards. But it's such a good project, there's such a demand in your stock, there's such a demand for your company that we don't even have to market it. This is what we call a bought deal financing. So again, the terms in red, you have a book runner, which is usually a bank that does all the work, and a syndicate of underwriters. Sometimes it takes more than one bank, sometimes you need 4 or 5 banks to kind of help you sell the deal. Usually, typically bought deals are much larger in size as well. The best efforts private placements, they're good for small amounts. Maybe, deals up to 5, maybe up to $10 million. I rarely see private placements that are more than $10 million. When you do a bought deal financing, it's multiple times higher. These can be 20, 50, $100 million or more. So that's when you need a bank rather than just individual brokers. So in this type of bought deal, there's also 1/2 of a share of a purchase warrant. So in this example here, this is $25 million, and also had a 1/2 of a warrant, good for 36 months. So if you bought 1,000 shares of this deal, you'd also get 500 purchase warrants that are good for 3 years. Again, if the share price goes higher, you can convert those warrants into actual free trading shares and sell them and make even more money. So again, that's an incentive for the people with money to participate in a deal and invest in your company. Again, another commission. Fees for the bank, 6%. This additional 15% is what they call a shoe. So the bank will say, I think I can get you $25 million, but just in case there's a bit more extra demand, we have the right to increase it by 15%. So sometimes you might even get lucky and get even more, depending on the deal. So this one here, this has a warrant of 36 months. The previous example had a warrant term of 24 months. You'll find that the term of the warrant changes depending on the economic situation of the world, what's going on right now. If money is easy to come, then the company, they're less incentivized to provide warrants with longer terms, because if stock markets are great, there's a lot of money going around, they can raise money easily, they don't have to offer warrants. Or if they have to offer warrants, they can put a shorter term. So that, because the company doesn't necessarily like warrants, they don't want to issue those warrants because it just means additional dilution later on. So it's more shares that they have to issue, more shares that will get sold in the market. It's more dilution for existing shareholders. So companies don't really want warrants, but sometimes they have to issue them in order to incentivize people to invest in their company. So in times are good, sometimes you'll see with no warrants, and also a shorter term. So you'll see previous example 24 months, this time 36 months. Sometimes it's a full warrant, so you'll buy one share, you'll get one full warrant. This one here is one share, you get half of a warrant. Again, more terms. Bought deal. The quickest, fastest way to raise money. The banker just comes up to you with a contract, says, sign here, we'll get you $25 million. You sign, and it's done within a couple days. Sole book runner, that means that 6% fee goes to, majority will go to that one bank who leads the deal. The syndicate, the remaining of that fee gets spread out between the other banks, and it just kind of helps pay for their overhead. Units is what you buy. A unit is only a share plus your warrant. And then also the cash commission. So most times there is going to be fees, right? There is cash commissions involved. Now also with bought deals, you have to pay attention to pricing because they are often discounted. Again, it's another incentive that the company has to offer the investors to participate in their deal and finance. Because if there's no discount, then the incentive for the companies, well, why would I participate in this deal then if I can just buy your shares on the market, right? So if you say, well, but I'll give you a 5% discount or a 10% discount to market, then they think, okay, we're trading at $5. You mean you'll sell me the shares at $4.50? All right, I'm incentivized. So bought deals are usually always priced at a discount to market. But one of the consequences of that discount is it will lower your share price. So here's an example of a company happily trading in the 50 to 65 cent range per share. They announced a bought deal right on or around November 10th or so. You can see the drop in share price and the increase in volume. So this company here announced a bought deal financing, I believe, at about a 30% discount. And it cratered the stock. Because it shows the investors, the public, that says, well, if you're willing to sell your shares at 30% discount, that's what you must think the value of your company is, if you're willing to share at 30% discount. Now the discount rate, it does vary. Again, in a strong market, the discount can be much smaller. maybe only 5% or 10%. 30% discount is quite excessive. But we saw in the previous example, it also had a 3-year term as opposed to 24 years. So when this deal was done, it was probably done in a time where money was not as freely available. It was a tough time in the market to finance, so they really had to incentivize people. They had to put a steep discount and offer a half a warrant that's good for 3 years. So again, on private placements, nothing's free, especially in the capital markets. Fees, they're shared by the syndicate, and what it does, it helps pay the street. And pay the street is in brackets, and this means most public companies that will have research analysts that cover them. So I was a research analyst at a time myself, so I 10, 15 years in geology and mining and exploration. I worked for a bank as a research analyst, so I would study these companies. I would put buy, sell, hold ratings on them, and I really liked the company. Actually, the company I work for now, Endeavour Silver, is a company that I covered during my time in research. I quite liked the company, quite liked management, liked the projects. Had a nice target, had a nice buy rating on them, and a nice share price. And we would help market the company. We'd say, hey, you know what, if you're investing in silver, you got to look at this company, Endeavour Silver. This is what I really like about them. But that information, that type of broker research it's free. Like I don't get compensated for that. But it's a service that I provide for the company to help build that relationship. So when Endeavour Silver does do a bought deal financing, which coincidentally we just did one last week, those fees, we will include that bank. It'll be as a thank you. Okay, well, we thank Dale with his research at Dundee for helping promote the stock. So we're going to include Dundee Securities in this deal. And so they will split the fees. So it's a way to pay the street, to make the researchers happier. So again, in Canada, this is another regulation. So all new shares issued to acquire a project, they're usually subject to a 4-month hold. So sometimes even if you do the financing, you get the shares, if you bought it in a placement, depending on the structure, you will be restricted in selling it for 4 months. But that just means in 4 months, you're going to have a lot of free trading shares hit the market and potentially sell your shares down and hammer your market. Again, beware of the warrants. Issuers don't like them. Remember, as a company, you don't want to issue warrants. You don't want to give up any free options unless you absolutely have to. But if you're a buyer, if you're an investor, you love them because you want that free option. You want that money. Long-term warrants, they could be problematic. And also beware of discounts. Here's the other alternative way to finance is just using conventional debt. So here's an example from a couple of years ago, again, another Canadian company with a project in the Canadian Arctic. This company is called Sabina Gold and Silver. They had a comprehensive $520 million financing package to build a mine up in Nunavut territory up in the Canadian Arctic. And you can see it's quite complicated. So $225 million is senior secured debt facility. And senior secured just means that if they fail to repay the company, or if they fail to repay that debt, that bank has security on it. It's like a mortgage on your house. The bank will take your house if you don't pay. This bank will take your project if you don't pay. There's a $75 million gold prepay facility, meaning that any gold that this company produces in this mine gets sold at a set price to the bank as well. And in this case, it's what they call Orion Mine Finance. So Orion, they will sell the gold directly to Orion. 125 million gold stream arrangement, which means that when this mine comes into production, they'll also have to deliver a set amount of gold every year to Orion Mine Finance at a set price. And then they'll also agree to do a $95 million private placement in Sabina. So they private placement. So they agreed to be a shareholder in Sabina. So conventional bank debt is the lowest cost of capital. And but it's also one of the hardest ones to qualify for because bank debts, they do a lot of due diligence, there's a lot of strings attached, a lot of covenants. But in return for that extra work and all that due diligence, they'll offer you the lowest cost of capital. So it's usually prime or LIBOR doesn't exist anymore, so it's what they call SOFR now, SOFR, secured overnight financing rate. SOFR plus 4.5% or whatever happens to be. There's also what we call a convertible debenture, which is convertible debt, which is debt that a bank offers you at a certain interest rate, and they have the option to convert it into shares at a certain time in the future. So rather than pay it back all in cash, they have the option to take it in shares. There's also what we call royalties and streaming agreements, where you can sell a royalty on a company. So if we had a mine that we're building, operating, we want to put a 1% royalty, we can sell that 1% royalty and basically bring that money up forward, right up front. Here's another example of a debt financing. This is Marathon Gold. Again, quite complicated. So here's the key terms. So again, a senior secured term loan facility of $225 million. And then basically set in stages. So 125 million, then another 100 million, and then 50 million based on certain milestones. The interest rate is 7% plus LIBOR, which I think at the time was quite high when this was announced in 2023. Right, interest rates were going up, and so I think this interest rate was probably about 11% money. So 11%. It's almost like some credit cards have cheaper interest rates than this. And then there's also a gold stream payable, 1.6 million ounces of gold, which they pay $17 an ounce for. And so this interest rate's quite high again, right? And this is because it's not your conventional bank. So this is provided by Sprott Resource Lending. So it's one of these special mining investment firms. You're not a typical bank, not a Santander. It's a Sprott. And usually they have higher cost of capital. So exploration companies, it's quite obvious, but exploration companies should never take on debt. That's one of the things to be aware of, right? And why is that? Well, it's because exploration companies, if you remember from those slides earlier, they have no revenue. So if you're an exploration company with no revenue, it'd be a terrible idea to take on debt because you can't pay that back. And here's a couple examples. This is a company called Kimber Resources. They had a project in Mexico. Rest in peace, 1995 to 2013. And what they did is they announced a $5 million bridge loan facility. So they took $5 million on. They thought they'd be able to put it into exploration, find some success, raise some money, and potentially pay it back. But the problem was, it didn't quite work out as well as it did. And they had to go to their lender, they had to go to Sprott and say, hey, sorry, we can't pay you back your $5 million. And it gets a little bit confusing, but Sprott ended up assigning that debt to a company called Endeavour. And they called the debt, they said, well, if you can't pay us back, I guess we get the project now. And so that's what ended up happening. So Kimber Resources is no more. Here's another example. This is a Canadian company called Norzinc. They had a project in Northwest Territories. It's a development project. They're not selling anything. They have no revenue. It's not an operating mine. But they're trying to raise money to develop. And so their major shareholder was RCF, Resource Capital Funds. And they also took a $6 million bridge loan to help. Financing was tough. This was back in probably May 2022. Mining industry wasn't all that great back then, especially for zinc companies. So they took a $6 million bridge loan, and sure enough, in that red box there, RCF as the guarantor, 6%, 8% capital, $6 million at 8%, but they're the guarantor. And so sure enough, they couldn't raise the money, they couldn't pay it back, and so RCF also took this project. So it's a good way to, and so if you're a shareholder of this company, you just lost everything basically, because your share price went down to zero, you went bankrupt because you couldn't pay your debt, the creditors are calling that security, they're claiming the mine, and your shares get delisted, they end up being zero. So if you're an existing shareholder, if you didn't get out or sell earlier, you would have lost a lot of money. But yeah, you lose money because they either go to zero, they stop trading, or you lose money. In this case, RCF ended up buying all the shares outstanding, but for fractions. I think it was 3 cents per share. So if you see the share chart for Norzinc, it might have traded at 10 cents, 15 cents. You might have thought it was a great deal to buy at 10 cents. But then when a company comes and says, well, you either take our 3 cents or you're going to wait till it's going to go to zero. So you take the 3 cents, so you take a loss. So don't take debt if you don't have any revenue. If you can't pay it back, terrible idea. Streamings and royalties. So royalties have become an asset of their own. So it's a source of cash flow that requires very little overhead. So there's a lot of companies out there that specialize in holding royalties. Franco-Nevada is probably one of the most well-known companies. So they sit back, they collect royalties. All the miners out there, they do the hard work, mining, producing, selling all the gold. And then as a contractual agreement, they send a certain percentage to Franco-Nevada, usually every month, every quarter. And if you have a lot of these NSR royalties from mines all over the world, you just sit back and wait for the money to show up in your mailbox. One of the companies I worked for was also a kind of a private equity company who specialized in royalties and streaming, and they termed it mailbox money because you just sit back and wait for the checks to show up in the mail. It's great. So here's an example, again, from Marathon Gold of a royalty financing. So these highlighted terms, in February of 2019, Marathon Gold sold a 2% net smelter royalty to Franco-Nevada for proceeds of $18 million. So you think $18 million is pretty good. Marathon Gold, they're a company that was developing this project at the time. They needed money to do the feasibility study, do some drilling. Said, well, this is a good way to finance. We can't do much on the equity side of things, but hey, if we sell a 2% NSR, we get $18 million. That's a pretty good deal, right? Most of these NSRs, they do have a buyback. So this one could be bought back 0.5% for $7 million. So 1/4 for 0.5%. So for 1/4 of the NSR you just granted, you can buy it back for $7 million. Now, fast forward 4 years, January 25, 2023, Marathon Gold did exercise that option. So they paid $7 million to reduce the NSR from 2 to 5. So now Franco-Nevada, the net to Franco-Nevada is $11 million out the door for them, but they still retain a 1.5% NSR. Right? So they got about just under half their money back, but only really gave up about 1/4 of the NSR that they acquired. Still a pretty good deal for Franco. Now, this here, fast forward again, so this here is the feasibility study financing, or feasibility study numbers from that project. So you can see the royalty here is accounted for in the economic section of the feasibility study, as they all should be. The royalty on this was $87 million. That's the projected revenue from that royalty, $87 million over the life of mine. So you look back in 2019, the company said, hey, this is not a bad deal. Let's sell the royalty. We get $11 million. We can use it to explore, develop, whatever. But then fast forward, look how much money they're giving away, $87 million over the life of mine, just to get that $11 million up front. So this is why royalties are an asset of their own. So this would be Marathon Gold. This project is, if it's not in production now, it's going to be in production shortly. And so this will be one of Franco-Nevada's cash flowing royalties. So you actually, if you have a company, you work for a company, and you happen to have a cash flowing royalty you're collecting, like, it's a great idea to sell it now. Like, sell it at any time you want. The competition for royalties are fierce because there's so many companies out there now. There's the big ones, there's Franco-Nevada, there's Wheat Precious Metals, but there's all sorts of other small royalty companies now. And their cash flowing royalties are hard to come across, and so if you have one, they will pay a premium for it. And so one of the ways to value it is, you just forecast the production. It's pretty straightforward to be able to forecast the mine's production per year. Take 1 or 2% of that revenue. That's your NSR. Calculate over 10 years. Do a net present value on it, and that's what you can ask for it. So you can pretty much get full value, or sometimes even more money for that royalty right now if you were to sell it, if you had a cash flowing royalty. Metal streaming, simply put, it's lending money for production-based payment. So a lender will give you money, but they don't want cash back, they want metal back. Right? So they would be happy to take a percentage of the gold, percentage of the silver, percentage of the copper, because they also believe in an increasing price in the commodity. So they'll give you a lower price. Okay, we'll pay you, if it's a silver stream, for example, and silver's trading at $30 an ounce, they'll say, look, we'll give you this money up front, sell us your silver at $15 an ounce, half of the spot price, $15 an ounce. And most companies say, sure, let's do it. Especially if silver is your byproduct metal. If it's a minor component, you can part with it. They still get $15 an ounce, and in exchange they do get cash up front. But usually these streams are for the life of the mine, and also any other discoveries. So there has to be something in it for the people putting up that money. But if the silver price goes up to $40 or $45 an ounce, they're still locked into that $15 delivery price. So it's good for the streamer if the silver price goes up, because they've basically secured a supply of silver or price of gold or whatever metal that is at a set price. On the M&A side of things, this is my specialty now in corporate development. The goal is always to acquire an accretive asset. An accretive, and also to save money by utilizing strategy. So for example, for me, our company's in Mexico. If we pick up a Mexican asset, we could potentially save money by the synergies, right? We could reduce corporate overhead. We don't need 2 head offices in Mexico, so we would consolidate. Now, in order to determine what is accretive, one must have an understanding of valuation metrics. There's two main types. There's a friendly transactions, typical 2-stage process. One bank approaches you, says they'll have a project I think you're interested in. I'm going to shop it out. It's a silver mine, but I'm going to shop it out to all the other silver companies out there. There's 10 others out there. Phase 1, here's some data. In 6 weeks, let me know what you think it's worth, and send me a letter. They say, okay, we like your number. You had the best number, and everybody else, they like you, they want to deal with you, so we're going to deal with you. You negotiate, and then congratulations, you had a friendly transaction. The other, and also in the friendly, you agree on a valuation. We think this is what you're worth. The company agrees, yeah, I think so too, or they might ask for a bit more. But it's a negotiated number, so it's a friendly transaction. The other type of transaction, not friendly, the opposite of it being hostile. And so a hostile transaction is an attempt to acquire shares directly from the shareholder. So again, these companies are publicly traded companies. They're shares on stock exchange. Nothing prevents one person out there going on the market and just buying and accumulating a majority of shares. And eventually they will own enough that they own the company. So that's another way to own a company, going hostile. This way you just buy the company without any kind of negotiation whatsoever. But it's hard because a lot of companies that are publicly traded, they have blocks of shares. So a company might have 30% of their shareholdings owned by one person, one individual, or one institutional fund. They might have 50%, and then another 20% owned by another fund, and another 10% owned by another fund. So it's hard to secure those. So if you're buying on the open market, you can sometimes only buy a little bit at a time. So what you have to do is you have to go to those shareholders and say, give me your 30%. If you convince them to sell you their 30% shares, then again, these rules change, but in Canada, it requires a 2/3 majority. But if you manage to get 90%, then it becomes automatic. So here's an example of a friendly transaction. This is Great Bear Resources. They had a project in Ontario, gold project in Ontario, Canada, and Kinross. It was a $1.8 billion transaction, 40% premium with a contingent value rate. So Kinross went to the shareholders, went to Great Bear, negotiated, said, we'll buy you, this is your share price now, we'll give you an extra 40%, $1.8 billion in cash or shares. And this is what it can do to the share price. So this is the share price for Great Bear. Everything's from November 2021 to December 2021, everything's kind of trading in line, gold price. Deal gets announced, Great Bear automatically 40% higher. Kinross, usually the acquirer will always trade down a little bit because initially the market has to absorb, okay, what the heck just happened? So if you're the buyer, your purchaser, you will trade down normally because you also just spent $1.8 billion buying an asset that maybe not very many people are very familiar with. And it takes a while for that to kind of settle in. But if you're a Great Bear shareholder, you're very happy. You just got instant, if you made money on Great Bear earlier, fine, but congratulations, you just made an extra 40%. Here's an example of a hostile takeover. Two royalty companies going at it. Now this was Elemental Royalties was the target and Gold Royalty was the acquirer. They tried to do something friendly. Elemental said, no, we're not interested. We're not going to sign a CA. Because usually if you want to do something friendly, you reach out to the company and say, hey, really like what you're doing. Can we sign a non-disclosure agreement or a confidentiality agreement? You can send us some data. We'll have a look at it. We'll come up to a value. And we can buy you for 40% premium of what you're trading now. Elemental knew what they had. They said, no thanks, not interested. We're quite happy doing what we're doing. We're not interested in being taken over, especially by Gold Royalty. So we're not even going to sign a CA. We're not going to even sign an NDA with you. And so in that case, a Gold Royalty really, really wanted this company, Elemental. They would have had to go hostile, which they did. So on December 20th, 2021, they went public and said, if you are an Elemental Royalty shareholder, we will give you 30% premium on your shares. Sell it to us. Here is the share price, November 2021 going on to December 2021. Everything's kind of trading within reason. Elemental gets their offer, or Gold Royalty goes public with their offer, more like, and Elemental trades up. Gold Royalty kind of trends down. And I put the price of gold there just to show that these swings in prices aren't necessarily due to prices in commodity price. So on December 17, the implied offer price for Elemental Royalties was about $1.78, because Gold Royalty was trading at $6.60 at the time, and they're going to give 0.27 shares of Gold Royalty for every share that every Elemental share. So the implied price is $1.78, so a bit of a premium. But what ends up happening is Elemental now they have to fight this hostile takeover. So they put a bunch of news out saying, no, we don't want to do anything with Gold Royalty. Their shares are overvalued. There's no way they should be worth $6.60. We don't recommend any of our shareholders tend their shares to Gold Royalty. So naturally it trades down. And so now by February 4, 2022, Gold Royalty trades down to $5.34. You're still locked in at that same exchange rate, but now the implied premium is shrunk. It's only $1.44 now. And then sure enough, by May 2022, the hostile bid expired. Gold Royalty is down to $3.62. Elemental Royalty is down to $1.37. So Gold Royalty dropped by almost 50%. and then the hostile failed. So here's, we talked about earlier about accretion and dilution. Now, why would Gold Royalty want Elemental? This is why. So at the time of the announcement, Gold Royalty shares outstanding, 134 million. Elemental Royalties shares outstanding, 69 million. That's first line here. This is their share price, market cap. Here's what you really want to pay attention to. So both of these companies, their business model is, again, acquiring these cash flowing royalties. Elemental actually had cash flowing royalties. So they're collecting, their royalty income on their balance sheet was about $4 million a year on royalties. So it's about 6 cents per share. So you take that royalty income, divide it by the number of shares outstanding. So they're generating revenue per share of about 6 cents. Now, if you look over at Gold Royalty, they only had royalty income of $190,000. This is in millions of dollars. They had $190,000 of royalty income, but 134 million shares outstanding. So their their revenue per share was a fraction of a penny. And so if Gold Royalty was able to acquire Elemental, you see on that pro forma, they would have issued 18.6 million shares based on that exchange rate. So the new count of shares would have been 152. The pro forma royalty income, that 4.29 million, would have been attributed to Gold Royalty. And all of a sudden their revenue per share is 3 cents a share. So it's very accretive to Gold Royalty. They went from 1/10 of a penny per share revenue to all of a sudden 3 cents per share revenue. So it's accretive. The amount of shares that had to issue, very much accretive. So massively accretive. Like it's almost a 2,000% gain on that revenue per share number. Also, but however, on the Elemental side of things, you can see why Elemental wanted to fight this hostile takeover, is because it would have been massively dilutive for Elemental. So remember, you would have had to give up 3.7 Elemental shares for every 1 Gold Royalty share. And you were already making 6 cents per share revenue on your Elemental shares. So does the deal really make sense for your shareholders? It does not. That's why Elemental fought it. So they're successful in fighting off this. Here's another example for a hostile M&A. This is Gold Corp going for Osisko Mining. This is back in 2014. The Gold Corp wanted to offer $2.6 billion for Osisko. Osisko says no thanks, undervalued. And so Gold Corp says, fine, how about $3.6 billion? We'll increase it by another billion, 3.6. And then Osisko still said no. And Gold Corp ended up abandoning that hostile takeover. They couldn't get it. They couldn't get the shares. They couldn't get people to sell the shares to them. One of these kind of regulatory things are shareholder votes required. Sometimes yes, sometimes no. So in Canada, shareholder approval is required when the number of securities issuable on an acquisition exceeds 25%. In the United States, it's 20%. So if you have to issue 20 to 25% of your shares to acquire something, you have to go to a vote. You have to ask your shareholders, is this okay? Can I do this? I think it's a great deal. But you have to hold it to a vote. But in this case, Gold Corp, to issue $3.6 billion in a transaction, it would have required normally, if it was in all shares, it would have required a vote. But it's risky because as soon as you put something to the shareholders, they might say no. And then all your efforts would have been gone and wasted if your shareholders said, no, we think it's a bad idea. So one of the ways that Gold Corp kind of went around it is by attaining a $1.25 billion credit facility by Scotiabank. So Scotiabank agreed to say, okay, well, here's $1.25 billion in cash. You don't have to issue as many shares. Now you're under the shareholder vote threshold. You can do it without a shareholder vote. So it's one way companies can get around a shareholder vote. So some key takeaways for capital markets and mining. Everybody should know what your company is worth. So if you have an internal model, even if you're in exploration stage, you should have an idea what your target is. You should know what you're worth. Also be realistic. There's a lot of companies out there, a lot of examples where companies, they are successful, they become a target for takeover, but they either fight it off because they think they're worth more than they actually are, but reality is they're not, and they should have taken that offer. There's a couple examples. Everybody needs to adapt to the market. Take advantage of the commodity cycle, and I think a lot of this, some of the speakers later on, like Nikki and Joe and Neil, will talk about a lot of these points. Fees, yeah, nobody likes to pay fees, but it is a necessity in our market. Like, there's no such thing as a free lunch. You can't get everybody to work for you for free. And seek advice from trusted sources. You know, there's a lot involved running a mining company, from the capital markets, the fundraising side of things. And if you're a technical person, geology engineer, sometimes that's your goal, right? You've spent so much time working in the field, you want to run a company, fine, but you might not have that skill set, which is okay because they don't necessarily teach all that to you. But seek advice from trusted sources, right? Because there's a lot of people out there that will just take advantage of people who don't know as much. Right? They'll give you, here's some financing terms that are terrible, terrible terms. And you've seen, I've given you examples of actual companies with experienced CEOs, board of directors, that do deals which leave you shaking your head, like, why would they do that? But they're experienced CEOs, CFOs, board of directors that said, let's do this. It happens. And so that's it for the introduction for me. If you have any questions, I have a few minutes to answer if you like. There's my email address. You can also follow up with some email questions if you like. But yeah, happy to answer any questions, or we can hand it over to our next speaker. Okay. Yes, question? I might need some translation. The question was, sorry.
¿Cuántos proyectos a lo largo de su trayectoria ha visto que han sido viables y cuántos no?
Perdón, ¿podés repetir porque no se escucha de acá?
¿Cuántos proyectos a lo largo de su carrera usted ha visto que han sido viables y cuáles han sido los elementos fundamentales a nivel de inversión que han tenido en cuenta?
Okay. So how many projects have I seen in my career that are feasible, and what were the financial aspects that made them work? I would say a very small percentage. If you look at the number of companies that are producing mines versus the number of companies that are just exploration projects, not very many exploration projects advance to become mines. I don't know the exact number, but it's a small percentage. Myself personally, I've seen in my time in research, and my other speakers will probably have some other ideas on this, but I've probably covered maybe less than 20 companies, maybe less than 20 projects that I've covered, and I followed from exploration to development to production. Less than 20, probably even less than 10 companies. Now, what made those companies or those projects successful is, when I look for projects, I look for, I guess, three things. On a gold project, multi-million ounce potential, politically safe jurisdiction for two, and number three, I like simple projects. So if it needs something that has complicated metallurgy, if it's refractory, I will probably say no to those. If it's in a risky jurisdiction like Russia, Venezuela, or any of the stands, no. It has to have some size. So it's usually, on a gold project, for example, a multi-million ounces, and also has to have a capex that's reasonable. It's no sense having 100 copper porphyries out there which all have $5 billion capex projects, because not all of them will be built. So it all really comes down to grades, infrastructure. So yeah, I'd say in my experience, less than 10 projects that I've seen that go from exploration, development to production, and it's, I'd say, size and grade are the two key elements. Size, grade, simplicity, small capex. I hope there's somebody able to translate that. That's a lot. Okay. Any other questions, or we can go to one more?
Okay, hello, here. Recently you shared us the graphics about when a major company acquires a smaller company.
Yes.
Always happens that the smaller company actions increase the revenue, the value of the actions. Why? What's the explanation of that?
So, I guess if you're the target company, if you're the smaller company, you're the target company, most people, their goal in life is to prove up a resource, make a successful company to make yourself a target. And so you kind of want to be taken over. Now, the bigger company, it's not always 1 + 1 = 2. And the bigger company, sometimes they're just looking for an accretive transaction. They need something to make themselves bigger, make themselves grow. So it's accretive to the bigger company, usually also because their share price might be traded at a premium. And so when it comes to valuation, they might be trading at 1.5 times NAV, or 1.5 times their worth. The smaller company, smaller, and so they don't get the market attention that the bigger company will. So that's why they're trading at a bit of a discount. And so the bigger company will see that as an advantage. And if you're a smaller company, unless you really think that you're really undervalued, the smaller company generally will go for that deal.
Okay, another question? Can I make you another question?
Yes.
Recently, we noticed that there are a lot of hostile acquirers. That can be a move to make the shares go up or go down, like a virtual acquirer.
Yeah, so hostile takeovers, if you see a lot of them, mostly it's sometimes because the other company is just not interested. And so you'll find that, especially in today's market where the gold price is high, the copper price is high, the silver price is high, they might not want to sell their company. They think, they believe in the price of copper is going to go higher. I don't want to sell my company. And so there's no choice for if the acquirer really wants you, they will go hostile. And so I find that depending on the cycle we are in the commodities, if it's lower, you have companies begging to be taken over because it's hard for them to make revenue. They'll be begging people to please come take me over. But in the high commodity cycle, they're not interested. Their valuation, they think they're going to be worth more. They think they're going to, or they think that, okay, if you want me, you need to pay more for me. So I think that's probably why we're right now in a high price environment. Yeah. Okay. Okay, so I think that's it for me. I think I will invite my next speaker, Nikki, to come up. And she'll give herself a quick introduction.